we were looking at financial market, the case where we don't just have a central bank, but we have a banking sector also. So here we saw how financial market equilibrium can be expressed one in terms of how supply of central bank money is equal to demand of central bank money. Then we looked at how financial market equilibrium can also be expressed as where overall money demand is equal to overall money supply. So we were looking at the second way to express financial market equilibrium, where we discussed first overall money demand. Now let's look at overall money supply. Now, overall money supply is given to us as money multiplier times the supply of central bank money. Now, the idea is this: when you have a banking sector, the central bank perfectly controls the supply of central bank money, and the presence of the banking sector leads to the multiplication of central bank money through the money multiplier process. Now, what is this money multiplier? Let's try to understand where does this multiplier come from? Why is the money supply a multiple of the monetary base? So to see how banks create money, let's examine what happens when the central bank increases the monetary base. So in describing this process, we'll make some simplifying assumptions. We're going to suppose that many households in the economy and many banks hold no excess reserves, and we're going to assume households hold no currency. This is just to simplify the explanation. And we're assuming the required reserve ratio is 10%. Now, suppose the central bank increases the monetary base by $100, right, where it buys a bond worth of $100 from the public and pays for it by creating money. So initially, the money supply increases by $100. Is the $100 of new currency that the public has. Since we're assuming households hold no currency, assume this $100 is deposited in bank A, right? So the deposits of bank A increase by $100. Now, this transaction does not affect your overall money supply. Why? Because currency in circulation falls by 100 and deposits go up by 100, right? So this does not affect the money supply, right? Because see, what has happened was initially currency went up by 100. This was the initial increase in 100, but now currency has gone down by 100, right? And the deposits have gone down by 100. So the change in money supply is still 100, right? It's still the same that we initially had. The overall change in money supply is still 100 that it was over here, right? Because initially you had $100 more currency. Now the $100 in currency went down and $100 of deposits increased. So overall change in money supply is still 100. So delta MS is 100 still. Although the change in money supply is still 100, but now the additional money supply is in the form of demand deposits rather than currency, right? Initially, that change in money supply was in the form of currency, but now it's in the form of demand deposits. But this is not the end of the story, because Bank A can now lend out part of the deposits it receives, right? It doesn't end here. Like initially, the central bank increased the monetary base by 100, the money supply increased by 100. And then what happened was we saw that $100 was deposited into a bank. This did not change the total amount of money supply because currency went down by 100, deposits went up by 100. But this is not the end of the story, because Bank A can now lend out part of the deposit it receives. Now, since the reserve deposit ratio is 10%, Bank A is going to put 10% of 100, the $100 deposit it receives, as required reserves. And it's going to loan out the remaining $90. Since we're assuming people are not holding any currency, anyone who gets a loan is going to keep the entire proceeds in the bank or pay to someone else who does. So any funds that are dispersed as loans will eventually come back to the banking system. The public is not holding any of the loan in the form of currency. So assume that this $90 loan that is issued by Bank A gets deposited at Bank B. So now what are the total change in deposits? Initially the $100 that was deposited in Bank A, and now the $90 loan which is deposited at Bank B. So before the initial deposit, the change in money supply was 100, the $100 new cash the central bank issued to buy bonds, right? After the deposit and the loan, the change in money supply is now 190. Why is that? Because see, initially you had $100 of currency, and now the $100 of currency has gone down, right? And the deposit is and the $100 that was deposited at Bank A, this is that $100 that is deposited at Bank A, plus the $90 now deposited at Bank B. So overall is 190. Overall is 190 because we have the initial $100 the central bank created, that $100 plus now the $90 deposit created by bank. So the total now change in money supply is $190 because we have the initial $100 which was originally created by the central bank, which eventually got deposited in Bank A. Bank A used that to create a loan of $90, which was deposited in bank. So the commercial banking sector has created $90 of additional deposits, which is now new money. So banks create deposits when they make loans, and the new deposits created are new money. Because remember, the definition of money includes currency plus deposits. Now, Bank B has received $90 of deposits, and given a reserve deposit ratio of 10%, it will keep 20% of 90, i.e. $9 as required reserves, and loan out the remaining $81, which will imply exactly the same mechanism as before. So assume this $81 loan issued by Bank B gets deposited at Bank C. So now you have $81 new deposits created, which is again new money. So now the total change in money supply is what? Initially the $100 the central bank created, plus the $90 deposits created by Bank A, plus the $81 deposits created by Bank B. Now, given a reserve deposit ratio of 10%, Bank C is going to put 10% of 81 as reserves and loan out the remaining. So these funds, this loan will also end up somewhere else in the banking system, which will in turn fuel the creation of additional loans and additional deposits, where these additional deposits are new money. The process goes on and on until there are no more funds to be lent out. And this process is very similar to the process that we looked at when we were looking at the goods market, right? Where initial increase in output leads to a rise in consumer spending, which leads to a further rise in output, which leads to a further increase in consumer spending, and so on. Here, what we have is another kind of multiplier, which is the money multiplier, where initial increase in deposits lead to a rise in loans, which leads to a further rise in deposits, which leads to a further rise in loans, and so on, right? Because we saw this initial deposit resulted an initial deposit this $100 deposit resulted in a $90 loan. That $90 loan resulted in a that $90 loan resulted in a $90 deposit, and then that $90 deposit resulted in an $81 loan, which resulted in an $81 deposit, which resulted in a $72.9 loan, and so on. The key takeaway over here is in a system of fractional reserve banking, banks create money because they ordinarily keep only a fraction of the deposits as reserves and the rest is loaned out. When banks make loans using the deposits they receive, they create new deposits, which is new money. Because remember, the definition of money includes demand deposits. Now, in describing this process, we made some simplifying assumptions: no excess reserves holdings and no currency holdings. If you were to relax these assumptions, then the amount of money the banking sector can create would be reduced. Because obviously, if you have to keep a greater fraction of deposits as reserves, you decide to keep excess reserves, so you're loaning out less. So then less new deposits are created. Similarly, if the public decides to keep some part of the loan as currency, then the fewer amount of that loan is being deposited back into the banking sector. So the banking sector will have less deposit money to loan out. So, but overall process would remain the same, right? Where banks make loans using the deposits they received, through which they create new deposits and new currency in circulation if public holds some of the loan as currency. And both of this is new money. Because remember, the definition of money is currency in circulation plus deposits. So the key thing to remember is that banks create money by making loans using the deposits they receive.